Buenos días a todos, bienvenidos. Bienvenidos a nuestro primer evento que hacemos en colaboración con EPA, por eso es un evento tan multitudinario. Estamos muy contentos de que hayáis venido todos, por parte del broker, por parte de ODDO BHF Asset Management y por parte de EPA. La idea de hoy es hablar de temáticas de presente y de futuro, ¿verdad? Tanto se habla si es tiempo para invertir en bancos. A principio de este año todos nuestros clientes nos preguntaban si era el momento de los bancos o no. Parece que ahora con las decisiones del Banco Central se ha pospuesto. Traemos una temática de futuro también, inteligencia artificial, mucho interés, un fondo que hemos lanzado hace 3-4 meses y que realmente está funcionando muy bien en términos de rentabilidad, pero sobre todo en tema de temática, una temática que atrae la atención inversora, y tenemos hoy el gusto de tener aquí al gestor para que nos lo comente. Pero antes de todo eso, para asentar un poco el contexto de cómo vemos la macroeconomía, tenemos con nosotros a Bruno Cavalier, que es el economista jefe del grupo. Está aquí invitado por Joana Craco y su equipo para que presente cómo ve la casa el contexto actual. Sin más dilación, le paso la palabra a Bruno, os doy las gracias, luego Bruno abrirá un turno de preguntas, con lo cual, por favor, a mano alzada, sentiros libres de preguntar cualquier cosa. So Bruno, it's all for you.
To be back in Madrid. It's only once a year, unfortunately. Many things changed in the past year, so I will describe the macro situation today. After 1 year of slowdown, the key message is rather optimistic, hence the title. So, winter is ending. So it's a bit chilly this morning in Madrid, but there are sun also, and I expect that for the world economy, the temperature will go higher in the coming months. But to begin with, we have to set the stage very simply by saying that for about a year now, the global economy is slowing down significantly, and in Europe the slowdown is much more severe than elsewhere in the world. On top of that, there is a very high level of uncertainty, especially regarding economic policy. We face some unexpected and sometimes unprecedented shocks, such as Brexit, such as the US trade policy. So the situation, as we speak, remains, from a global standpoint, rather weak. So where are the positive developments? I would mention three things before turning into the details and maybe draw your attention to some charts. We could say that some months ago, when financial markets get scared by the deterioration of the global economic conditions, there were mainly three sources of anxiety. One was the increasing trade frictions between the US and China. Secondly, the state of the Chinese economy and the risk of hard landing. And thirdly, a concern regarding monetary policy and the risk that maybe in some countries, and especially in the US, monetary policy would turn overly restrictive. Now, if we look at those three concerns, what we can say is that in the past few months, past 3 months, let's say, things have changed in a positive direction. All those issues are not settled yet, but they move in a more constructive direction. First of all, regarding US-China trade frictions, where they are negotiating, which is better than implementing new tariffs with more retaliation and so on and so on. So we don't know yet when those negotiations will end, but at least there are negotiations and there are a lot of rumors and news that a deal will be signed quite likely in the coming weeks or months. So it's a ceasefire, but lasting longer than what was expected. So this is a positive development in a way. Secondly, China. The latest data we have. Okay, the latest data we have on China confirm that there is a slowdown, but there is no hard landing. And it seems that at the start of 2019, the macro situation is not deteriorating further in China. So again, this is a positive development. And finally, regarding monetary policy, well, it's obvious to everyone now that there is not a single central banker in the world pushing for more restrictive policy stance in the coming months, quarters, and maybe years ahead. And in the case of the US central bank, they have shelved, and probably for a very long period, any plans to increase interest rates much higher. So, as I said, the situation is not settled. The issues I mentioned are not settled today, but compared to some months ago, I would describe the situation as a bit more positive. So this was general remarks, and now I want to go maybe into more details. I will divide my remarks in three parts. First of all, a snapshot of the macro situation. Secondly, I will turn to kind of recession watch of major economies, and final remarks regarding economic policy and especially monetary policy, since it's very important for the direction of interest rates. So of course I will not comment everything, and you have in the booklet, of course, all the charts. So to begin with, maybe I would like to draw your attention on the chart, the bottom right here. I think I said uncertainty is high. It's not only a gut feeling. We can measure uncertainty regarding global economic policy. We have indicators. They have been developed in the past few years by US academics. And this is one metric measuring uncertainty at the global level. And as you can see, it's very, very high. And it increased continuously last year, mainly as a result of the trade frictions I mentioned between the US and China. And at the start of 2019, maybe it's exaggerated to say the situation is stabilized, but if it's stabilized, it's at a very, very high level. So this is something we have to consider. This unprecedented level of economic policy uncertainty. Of course, it creates a lot of fears among market participants from time to time, depending on the news flow, when the deal is about to be signed, no, it's postponed, and so on and so on. So it's something very important to keep in mind. And of course, this chart is to be related to the chart above, the top right, which is the history of US trade policy since the beginning of last year. It started with some tariffs, a very small amount of US imports, but over time, the amount of tariffs implemented on US imports increase and increase and increase. And on top of that, the threats of additional tariffs, which is the red line, increase much, much further. Since October last year, the situation has not changed. We still have threats, and this week we had more threats coming from the US administration on the European Union, but no more tariffs. The situation is more or less stabilized, which means no more retaliation. Of course, the ideal scenario would be to go back to a situation with lower tariffs, because what we can see with the benefit of insight, after 1 year, more than 1 year of trade frictions, is what you can see on the bottom left chart, which is world trade. Well, world trade has declined at the end of 2018 and the start of 2019, and obviously it's the result of two developments. One is less growth, less demand, but secondly, more frictions. So for an economist, this is not a surprise. We know that world trade is positively related to the volume of world trade is positively correlated with the fluidity of world exchanges, and negatively correlated with the level of tariffs. So if you increase the tariffs, you reduce the volume of world trade. It's very important, this chart, because as you can see, it's not so often that you can see a contraction in world trade. Just a remark on this slide, which is an overview of financial conditions. Starting in 2015, the US Central Bank increased interest rate. Last year, they increased policy rate 4 times. Now they have changed direction, but as a result of this monetary policy normalization, the situation today in the US is that we have practically a flat or slightly inverted yield curve. This is a very serious warning signal for future economic conditions. I mean, in the past or historically, we could say that the slope of the yield curve in the US, it does not work so well elsewhere, but in the US, an inverted yield curve most of the time occurred 12 to 24 months before a recession. So at face value, it suggests that 1 year from now, the US economy could be in a recession. We have some reasons to think that the situation could be slightly different today. First of all, if we cross-check this signal with all the data we have on the US economy, we do not have the confirmation that the US economy is about to relapse into recession. So it's a very important thing. Secondly, we must keep in mind that after so many years of direct intervention of the central bank on capital markets, well, the signal coming from long-term rates is probably skewed, different from what it was in the past. And I want also to mention a third difference with the past. It's not the same thing to have an inverted yield curve at 2.5 10-year yield, which means basically real rates close to zero, so not restrictive, which is the case today, or inverted yield curve at 5% nominal terms, or close to 3% in real terms, long-term rates, which was the case 10 years ago. So I don't want to disregard this signal because it's very important, and probably you've seen, and we will read more and more stories on this, beware of the yield curve and so on and so on. But we should maybe consider this signal into perspective. Anyhow, financial conditions tightened very significantly at the end of last year, and after the U-turn by the Fed and other central banks, the situation has turned a bit better today. And we had a very strong rally on world equity markets. So I won't comment this because I will go back to the US and Europe just in a minute. One additional remark on China. As I said, China is probably the second big concern in investors' mindset for many, many months now. There is a slowdown, as I said. As a matter of fact, there are two sources of slowdown in the Chinese economy today. One is made in China slowdown as a result of more tightening of the banking and financial sector, which in a way is good news because it means that Chinese authorities look forward more sustainable growth. And the second slowdown was made in America. Was the direct result of the pressure on the export sector. And this is the topic which is today under negotiation between China and in the US. The most recent data we have on China, and especially business confidence indicators, have turned slightly more positive. I think you can see this on the top left chart with the business climate indicators in the manufacturing sector. It's very close to the so-called critical threshold, but it's better to be slightly above than below the threshold. On top of this, we also have to consider that the construction sector, which is very important, looks rather resilient this time in China. So those were my first set of remarks, just to set the outlook. Now I want to turn to the recession risk. Is there a serious recession risk in the US and, more importantly, in Europe? Well, in the US, I've always said a few things on the yield curve. When we look at the confidence indicators in manufacturing, in services, in construction, among large companies or small and medium-sized companies and so on, and you aggregate all those confidence indicators, as I did on the left-hand chart, you can see that from a very, very high level, there was a significant decrease at the end of last year. But from a very, very high level, we have to keep this in mind. But Q4 2018 was rather peculiar, and especially on financial markets. As you can see on the right-hand side chart, it was the largest negative wealth effect on a quarter since the end of recession. On top of this, we had just the start of the government shutdown in the US, which lasted more than a month, which is the longest shutdown in the US history. So I don't think that we should take this Q4 situation as a benchmark for the near future. Of course, data have been affected by the shutdown, by those financial shocks, but overall, we can see again that there is some stabilization in business confidence at a rather high level, at a level consistent with, I would say, US trend growth of 2.5% for the maybe coming 2-3 quarters, which is above trend. So the US economy is decelerating from a situation much, much above trend and will converge towards trend maybe by the end of this year, early next year. So of course there could happen a recession if there is a shock, a huge shock, but as we speak, I don't think that we have the conditions here to have recessionary dynamics. So we can move on to Europe, because Europe is a much more serious situation. Europe represents the largest negative surprise in the world economy over the past 12 months or 18 months. Because we move from a boom situation to very close to recession threshold. Why? Well, the explanation, in a way, when we were in a boom situation in Europe, that is 1.5 years ago, it was the result of two developments. One, very strong domestic demand. Two, very strong external demand. What has changed in the meantime is that domestic demand has remained rather strong, not much weaker than a year ago, but external demand has completely disappeared. As a result of the global slowdown, and in the case of Europe, with more specific shocks. You can see this on the right-hand chart, which represents the contribution to Eurozone exports by a few countries. Just consider a country like Turkey, which is not the largest export market for Europe, but it's an export market. But Turkey moved from 6% GDP growth to -3% in a matter of months, which means that the contribution of the Turkish crisis on EMU exports explains more than 1 point of contraction. This will not be repeated this year. You can also see that even though Brexit has not been implemented yet, and the latest news is that it's postponed for maybe 2 more quarters, it has also a negative contribution on Eurozone export. So the situation of the Eurozone economy today is very much a picture of a dual economy. You have a rather strong domestic demand, rather resilient services sector, construction sector on the one hand, and on the other hand, you have an industrial slump, an industrial recession, and especially in Germany, and especially in the automotive sector. The automotive sector in Germany represents 5% more or less of value added, which is 4 to 5 times more than in other European countries. So it's the backbone of the industry in Germany, and the manufacturing sector is the backbone of the German economy. Hence the situation today with a lot of stories about forthcoming German recession. No, today the German industry is in recession, but at the same time domestic demand is good. There is full employment. There are twin surpluses, budget and external surpluses. And this is what makes the situation so peculiar today. We have this kind of duality and diverging trends between manufacturing and services, or manufacturing and the rest of the economy. Of course, manufacturing, even in Germany, is a much smaller share, 20% of value added in Germany, closer to 10% in Europe, than the rest of the economy. And we also have to consider that manufacturing sector adjusts much more quickly than the rest of the economy, which means that quite likely, or at least that's a fair assumption to make, it's not unlikely that we are close to the trough in terms of industrial activity. And so, if this is true, then what we will observe in the coming months is a convergence of manufacturing to the rest of the economy and not of the rest of the economy to manufacturing. I have, I think, 5 minutes left, so I won't comment on France, I won't comment on the UK. I want to say a few words about monetary policies, or economic policies, but more specifically, monetary policies. A few remarks on the Fed and then on the ECB. The Fed made a complete U-turn in the past 3 months. It's quite unexpected, and it remains rather difficult to explain based on the usual reaction function of the central bank. Because, as I said earlier, the US economy is in pretty good shape today. Many people describe the US economy as some kind of Goldilocks. You know, it's not too cold, it's not too hot, it's just perfect. You have full employment, you don't have inflation, for a central bank, it's a perfect situation. In spite of this situation, the Fed made this U-turn. So why? It's possible that they have reacted to the deterioration of economic conditions elsewhere in the world, but normally they set their policies for themselves, not for the others. So I don't think that this is the explanation. The main explanation is what I showed you earlier, which is the negative impact of capital market developments in Q4 last year on the household balance sheet. I think they were frightened by what happened, and they want to buy an insurance. So what they did is risk management. We don't expect, it's not their central scenario, a recession, but we have to adjust our policies to the most immediate risk. So as we speak today, it's pretty clear that they have no intentions to raise rates further. And as a matter of fact, and this is the first time in about a decade, there is no more forward guidance coming from the Fed. The next move could be up or down. They don't know themselves. No, they want to keep all the options open. What are the conditions to see the Fed increasing rates again? The condition, minimal conditions, is to have a significant and lasting upturn in inflation. As we speak, it's very unlikely. But maybe 1 year from now, if the labor market conditions continue to be very strong, if wages continue to accelerate, then maybe there will be some transmission to prices, and then they would consider rate increases. But not in the foreseeable future. To consider a rate cut, well, obviously, we would have to observe a much more severe slowdown than what we had yesterday. One additional difficulty or issue for the Fed is that they are under a huge political pressure. And this is the first time in many, many decades, probably the first time since the early 1970s. Almost every day, the US president or his advisors publicly said the Fed made huge mistakes, ridiculous mistakes. They should cut rates, they should launch QE again, and let's imagine that the Fed thinks that it's rational to cut rates. They might be cautious of doing so because of this pressure. Because from a credibility standpoint, if people start to think that they have acted because of the pressure, then it's game over. So this is an additional problem for the Fed. Today the markets completely disregard this, consider that it's a pure show. I think that this is something we have to keep in mind. Just to finish, a few words on the ECB. Mr. Draghi yesterday confirmed that the situation or the risk were continued to be tilted on the downside, just normal insurance coming from the central bank. What happens if the situation continues to deteriorate? Can they ease monetary policy again? Well, the answer is probably yes. But to do so, they would have to probably mitigate the negative side effects of their policies on the banking sector. So this is a debate under consideration at the ECB, how to make sure that the negative interest rate does not hurt banks' profitability further. They have not reached a conclusion on this. If they find some way to mitigate the cost, then they open the toolbox to more rate cuts in the future. This is not our central scenario. Our central scenario is that they will stay put for a very long time. They will continue to reinvest all the maturing assets in order to maintain a very accommodative policy. Final remark, you know that Mr. Draghi terms ends in October. Of course, nobody knows who will replace him. There are rumors, and recently serious rumors that the German candidate is back in the race again. If that happens, will the ECB policy turns restrictive immediately? I think the answer is no. No. Why? What we observe today is that the ECB is already committed beyond October 2019 to a certain number of actions. More TLTROs, more reinvestment policy, no debate on exiting the negative interest rate before 2020. So in a way, what Draghi is doing today, that's my interpretation, is trying to tie the hands of the successor in order to have his legacy not put into jeopardy once his term is over. Those are my remarks. They are could be much more things to say. Maybe we have time for a couple of questions, and before leaving the floor to Alex, I think. Sorry?
On page 16, when you're looking at the auto industry in Germany.
Okay, yes.
Yeah, the two graphs, I mean, why they're so different?
So one graph is the production, and so the other one is in a way backward looking, and the other is upward looking. What you have to consider, in a way, here and here is the same story. It's the story of the implementation of new regulations. Sorry, I have to speak on the mic. Otherwise, I see the people behind the camera. They are not happy at all. So it's just, it does not measure the same thing. So you can't compare exactly the level. You have to compare the dynamics. What occurred last year is in an industry which is going through a kind of existential crisis. Because automotive tomorrow, who knows what will happen. But on top of this, last year, there was a specific regulatory shock which disrupted completely the production. Hence, you see the decline. The other chart suggests that this shock is over and will correct in the coming months. But we are still waiting. That's the story. And as I said, if it was only a regulatory shock, in a way we could say, well, it's a one-off, we can move on. But on top of this one-off, you have less external demand, you have a huge uncertainty regarding Brexit, you have a huge uncertainty regarding maybe tariffs imposed by the US administration on European car imports, plus more long-term issues with electric cars and sharing and so on and so on. Thank you very much.
My pleasure.
See you next year. See you next year. Thank you.
Le doy paso a Alex Koagne, gestor de nuestro fondo de bancos, para que haga una revisión del sector. Una temática que
Es la siguiente, ¿no?
Yes. Hello, everybody. My name is Alex Koagne. I'm a fund manager at ODDO. I'm here to talk about the banking fund that we manage. So I've been covering bank for 15 years. So I've been following the crisis since the beginning. I can talk about the banking sector during hours and hours, but I will try to present you the banking sector as I view it, as I think it will evolve, and why I think that it could be a good investment going forward. Before jumping into how we invest into the banks, let me first try to put the bank into the context and into what we think it is a good value creation from banks. So here you have a kind of summary of what we think about banks, or what is supportive, what is negative, and how we position. So from here going on, what we really think is that things are getting better. I'm not going to come on back onto the economic evolution, but I think that what we saw from here is that soft data are getting better. This is one thing which is very important because it's a key driver for the banking sector performances. Second point is that ECB is clearly thinking about implementing a tiering rate, which is clearly good. As you know, banking has been suffering so far because of negative rates. Third point is that EPS cuts are reducing and kind of normalizing or stabilizing, which is a very good point. And as you can imagine, we continue to wait for an agreement on the Brexit or an agreement on the trade war between the US and China. And any positive outcome from those two elements will clearly have a positive impact on the cost of equity of the banking sector and therefore support the rating of the banking sector. As you can imagine, from the negative side, number one is that rates are set to be low for longer. Clearly, we are not expecting the Euribor 3 months to increase anytime soon, and specifically if we have a tiering rate. This is one of the key points. Second point is that the cross-border consolidation, which from my perspective, if you think about the negative rate, is something which is needed for banks to increase the profitability. It's not happening, but the question mark here is if the Dutch bank, Commerzbank merger is going to happen, is that a kind of trigger to see more M&A? We can just discuss about that. And those are the main points that we are going to see. And obviously, I think that we can also talk about the deglobalization and the kind of pressure it put on banks to have more capital to deal with the volatility. In this context, how are we setting the position of our portfolio? We tend to be pretty focused on banks with a strong capital generation. We tend to look to banks with strong exposure to insurance, wealth management, because those are very strong activities with light capital consumption. And we clearly tend to look at banks that are in the position to generate positive juice. Positive juice is very important because it means that you are able at least to grow your revenue faster than your cost base, which is very strong for value creation. So let me jump directly into valuation. Why do we think that the banking sector is interesting to look at this point of time? Because of this chart. This chart is a summary. I can present that and go back to Paris, because if you understand this, then you don't need to know more. Why? If you look at that, this is 10-year evolution of the banking sector relative to the market. The first two part of the chart is the price to book and the PE relative to the market. And what you see is that today we are near to the lowest level we have reached over the last 10 years. When you look at the price to book and the PE, we are somewhere around 0.43 for the price to book, which is near to the 0.39 we reached at the lowest point we reached on the last 10 years. And it's the same thing for the PE. At the same time, you see that the profitability of the banking sector has been re-rating against the market. Valuation-wise, it is going down, but profitability-wise, it is going up. This is a kind of abnormal situation, and I think that this will normalize when we will have clarity on where we are going in terms of rates, where we are going in terms of, let's say, political uncertainty relating to Brexit, relating to the trade war. So it is unusual to see a sector having better profitability, but having a relative valuation going down. Second point is the implicit cost of equity. As you can see, the cost of equity has been very high on certain time. This was during the crisis and also during the Brexit. And today, we are still on the very high level. If you see the average cost of equity on the last 10 to 20 years is 10%. Today, we are somewhere around 11%, meaning that we have a kind of extra risk premium of 100 basis points. And to me, this is mainly linked not to the underlying performances of the banking sector, but to the kind of noise surrounding the European banking sector. I'm talking about the Brexit, I'm talking about the trade war, I'm talking about the situation in Italy. And the key question is this kind of premium going to normalize? I think so. I think so. I think that if we have a good positive outcome on the Brexit, if we have a kind of normalization of the situation in Italy, which should happen in 2020, and a kind of agreement between US and China on the trade war, we can come back to the 10% average. And you see on this chart that depending on the level of the cost of risk, this is the upside you can have from here. So going back to kind of 10%, it is 9%. Going back to 9%, it is 21%. And going back to 8%, it is 36%. The key question is, what does it cost to go back to 9%? To go back to 9%, you just need to have no more kind of political interference going forward. And this is the level what we have seen before. The key question again is, if we think that the banking sector should trade around 9%, why so in terms of cost of equity? Just because today, in terms of solvency, in terms of liquidity, the banking sector has never been so strong. Never ever before. So therefore, if they are so strong in terms of capital, in terms of liquidity, it is a kind of given conclusion that the profitability won't be as high as it used to be before. Therefore, if they are stronger, profitability-wise lower, the cost of equity should just go down. I'm not betting that it will go below 10% or like going toward 8%, but I think that something between 9 and 9.5 is a kind of normal for the new world. Let me just skip those two charts, which give you the price to book and the relative and the PE of the banking sector. And the good thing to know on those charts is that each time you are crossing the average minus the standard deviation, we are kind of pricing a systemic risk, which was true in 2009, true in 2011, true in 2016. And as of today, I don't see any reason to price a systemic risk because I don't see any in the horizon. So therefore, it is a kind of trough for me, and I'm expecting the banking sector to rebound from there. This is the second most important chart you have to bear in mind. The banking sector follows the view that we have on the economy. As you can see, the banking sector is really correlated to the PMIs. So whenever you think that the PMIs are going to improve, then you should invest in the banking sector. When I was here in March, well, I told you that we start to see a kind of rebound on the PMIs. This effectively happened, and you see that the banking sector clearly followed that. Why are PMIs so important? Those are leading indicator of your GDP growth. So whenever we think that the economy is going to grow, the banking sector is in the heart of the economy, so therefore it means higher profitability. And the good thing, we can talk about where the economy is going. Are we going into recession, blah, blah, blah. I think that you have a very good presentation of where we stand in the cycle by Bruno. The only thing I want to show you is the next slide, which for me tells the story. what you have here are the leading indicator of the major economy, China, US, and Europe. What you see is that the improvement of the soft data in Europe and US have 6 month lag to the China. And if you allow me to just show you. So you see, at the peak, when China started to see the soft data going down, Europe and US was still growing. And what you see here is that the China have already troughed, and US and Europe and US are still declining. So the conclusion of this chart is we should expect PMI in Europe and US to improve in June of this year. Therefore, if that happens, what you saw on this slide will just continue, meaning that I don't believe that there will be any recession. And if the stimulus that the Chinese, US, and Europe are injecting in the economy will support the economy going forward, you should expect a rebound of the leading indicator in Europe and US, and this will clearly support the rebound of the banking sector. So I really want you to have those on mind, because those leading indicators are really important for the banking sector. Then we come into this. This is the value creation by a bank. Those two charts are, number one, the evolution of the book value per share of the banking sector. And number two is the evolution of the price of the European banking sector. As you can see on this slide, since 2009, the book value of the banking sector per share has not increased. It's just like you have put some money in an account and you have get any interest from this money for the last 10 years. Therefore, your value or your wealth have not increased. This is what happened over the last 10 years for the banking sector. The book value have stayed at the same level. And the price of the banking sector have followed the trend. Why should the price goes up if the value creation of the banking sector is not increasing? And then the question is why the banking sector wasn't creating any capital. Reality is that they have been raising massive tons of capital because of regulation. They have been raising billions of capital year after year. And therefore, because of those capital raising, the number of shares into circulation have increased massively, so that, end of the game, your book value stayed at the same level. So the key question now is, are we still in the world where we are going to see massive capital increase? First answer to the question is no. Why? Because year after year, capital raising has started to fade away, and you see that dividend distribution have taken the lead. So that you see in 2018, we have not seen no capital increase, but the dividend distribution have increased. So the conclusion is the capital raising for solvency purpose is finished. But because the profitability is not that strong and the growth is not that strong, banks have nothing to do with the extra capital they're having today. Therefore, they are giving it back to the shareholder. And if you ask me, down the road, 10 years down from here, the banking sector, like the insurance sector, will be the high dividend yield sector of the stocks 600. Second point on this is the kind of correlation between how my book is growing and how the share price is growing. You see right in the middle that if you look at the European market, the stock 600, the book value grew in average by 14% over the last 5 years, and the price of the stock 100 have grown by 16%. When you look at the banking sector, the book value has decreased by almost 10%, and the share price have decreased by 25%. So if you don't grow your wealth, there is no way to see the price of this wealth going up. So if you think about where we are today in the cycle, and then you think that from 2009 upward, we will see a growth of the book value, and this is what will happen starting this year. We are expecting the book value to grow by 4% in 2019 and another 5% in 2020. Why? Because there is no more regulatory adjustment that will hit the book value. There is no more capital increase that will hit the book value. So, assuming you don't see an expansion of your multiple, assuming the price to book stays at 0.7, but your book grow, your share price will just follow. So therefore, you don't need multiple expansion to have a higher price. You just need to grow your book. And this is what we'll starting this year. So therefore, as an entry point, 2019 is a pretty interesting year. Let me show you also this chart in terms of dividend distribution, because I think it starts to become key. On this chart, you have the distribution of capital raising and dividend per country. And as you can see, Nordic banks have been the highest dividend payer so far, following by, let's say, Benelux, French, and the UK have finished with the issue, and now today, those banks are just dividend payer. And if you look at a bank like Lloyds is clearly a dividend machine. And I'm expecting all those country and bank of those countries to just follow this path. So I'm expecting a kind of increase of the dividend distribution from the Benelux, from French. In Spain, it is not there yet, but I think that going forward, if they succeed to get the capital they need, it will just increase. So when we are investing into the banking sector, we are taking this into consideration for the allocation we are doing. Then this is the other chart I want you to have in mind. And this is what I was talking about, the banking sector being a yield sector going forward. You have the combination of two things on this chart. Number one, the yield. The banking sector is the sector with the highest yield into the stock 600. And then the second point is that the dividend is also, the banking sector have also the fastest dividend yield, dividend growth into the stock 600. So they are in the very nice spot where you have high yield and high growth. And the only other sector which is in that bucket is the insurance sector. And guess what? Since 2012, insurance is one of the best performing sector of the stock 600. Insurance is one of the best. I think that it is the third best performer of the stock 600. Why? Because low EPS growth, 5 to 6%, but high dividend yield. And I'm clearly expecting that the banking sector will follow that path going forward. I'm not going to present you that chart today, but it is an interesting one. Let me just talk a little bit about the tiering rate. As you know, one of the reasons why the banking sector has been under pressure is because the revenue growth is not there. Why? Because rates are very low. If your rates are low, you cannot reprice your book, and the money you're earning on your loans are not sufficient to cover your costs. The good thing is that Draghi, for the first time, a couple of weeks ago, said that they will envisage to reduce the charge that banks are paying on the excess deposit they have at the central bank. We run some calculation based on the ECB data. Pretty simple. If the negative rate that is applied on the excess deposit that banks have the ECB is back to, is moved to zero, then you have a 5% impact on the PBT, which is massive if you consider where banks are today in terms of profitability. We are talking about 20 to 30 basis point improvement of the profitability. And if that happens, it will benefit most to the German, to the Belgium, to the French banks, and it will benefit less to Italy and Spain. Why? Because they are net borrower at the ECB. So the other way to think about the tiering rate is to say, as of today, French, German, Belgian banks were net deposit, were those having excess deposit at the ECB, and they were charged a negative 40 basis point for that money. But at the same time, Spain, Italy were net borrower, and they were getting money with a premium of 40 basis point. The tiering rate is just a way for the ECB to balance, to say that, okay, I will just take out the negative 40 basis point I was charging to the France and France, Germany, and Belgium, but at the same time, the Italy and Spain will continue to benefit from the 40 basis point premium on the money they take at the ECB. So it is a good thing to have this tiering rate, but it doesn't solve the equation. This chart is just to show you that we don't expect rate to increase anytime soon. I mean, after the ECB comment on the fact that they are moving possibly toward a tiering rate, you see that the market is now expecting that the next interest rate hike will happen in 24 months from now. So meaning that somewhere in 2021. So therefore, as you can see, the Eurobond 3-month is set to remain on the negative territory until 2021. And the good thing, just to have in mind, is that whenever the ECB is going to increase their rate by 25 bips, it has a positive impact of 5% on the European bank earnings, meaning that 100 basis point is more than 20% uplift on the EPS. So it is a massive trigger for the banking sector. And if things happen the way we think, starting 2020 and 2020, we start to have some tension on interest rate hikes if it is the German guys that get to the ECB. So as you can see, those are just trends of the EPS on the banking sector. The good thing is that we start to normalize those last year days, and the reason behind is that the market has already factored into the consensus that there will be no rate hikes, and banks continue to work on the cost base. So I think that going from here, going forward, I don't see significant downside on the EPS because everything is, I won't say everything, but I will say most of the concern regarding rate are priced into the banking sector. So this is the evolution of the EPS. This chart is just to show you that if we look at the performances of the banking sector in 2007, before the crisis, we just divide the revenue by asset, cost by asset, cost of risk by asset, and the net profit by asset. What you see is that the banking sector will kind of going back to the level they were in 2017, only in 2021. And even at that stage, they won't be earning the 50 basis point they were earning on the asset. It will be slightly below. But it is also good to see that they have done tremendous job on the cost base, which went up because of the investment into the IT, because of the litigation. And now we are seeing a kind of decrease in the cost base. And what you see at the same time is that the margin is going up. So bottom line, profitability will keep up improving. And if the bank are able to grow the book, and this is what I really think that they will do in the coming year, then we will see an expansion of the price, even if we don't see an expansion of the multiple. So then we can spend hours and hours on why there is no consolidation on the banking sector. The only thing I will tell you is this is a political game, okay? As long as we won't have the implementation of the banking union, there will be no consolidation. And if we are in the position to have consolidation today, it is just because political will are behind more than anything else. So this is basically what I want to share with you this morning. Here you have our portfolio and the key metrics relative to the bench. What I want to show you is where we stand as of today. As of today, we are something like 165 basis points above the bench. We are working hard to continue this. And if you want to see our positioning, this is what you have in terms of positioning in our book. We clearly have a strong exposure, yes, we clearly have an exposure to insurance. We want to have a strong exposure to asset management, and obviously we have a very strong exposure to banks. And I think that if you go through the presentation, you will have our top picks and so on. I don't want to spend more time because I think that Brice need to talk also. I don't know if you have any question or... Thank you very much for your attention.
Le voy a dejar unos minutos con Brice, que es el que lleva el fondo de inteligencia artificial, y va a hablarles unos minuticos sobre ese fondo que se acaba de lanzar en ODDO.
¿Es la misma presentación?
¿Sí la misma presentación?
Pero
Sí, es la siguiente.
Es la siguiente, ¿a qué sacarla entonces, no?
Me imagino.
Esta no es, de aquí. Es otra presentación.
Se servirá.
Je suppose que c'est pas moi qui ai fait le document.
Me imagino porque no está... Sí, debe ser. A ver, si la queremos seguir aquí, ¿cómo hago?
Sí, esto para adelante, esto para atrás. Yo tengo un computador láser, ¿vale?
¿Se servirá antes? No. No, c'est pas le tiempo, ¿no? Après, si se lira.
On n'arrive pas sur l'écran là.
No.
Oh, good morning, everybody. Thanks for being here today. Thanks for taking the time for this session this morning with us. So I'm Brice Prunas. I'm the lead portfolio manager of ODDO BHF Artificial Intelligence. So we are very proud to present you today this fund because it's an innovation at ODDO BHF and probably an innovation in the asset management industry, because actually it's a first fund, thematic fund on AI, artificial intelligence, but that use artificial intelligence as well in the investment process. So you should look at this fund as a global equity fund, first of all, only equity, no private assets, 60% US, 10% Japan, 10% emerging, and as a result, only 20% Europe. In this portfolio, you are going to find 60 companies with very strong equity story. All these companies derive a competitive advantage from artificial intelligence, whatever the sector, whatever the market cap. So you will find basically 55% of global tech companies, but also half of the portfolio are all over the sectors, as long as the company can derive a strong competitive advantage. And you will see later that we already got several companies being acquired because of this competitive advantage, and of course we got the premium for that. So the fund has been launched end of December, 19 December, and since inception the fund is up already 19%, slightly less than 19%, which means that we are ahead of MSCI World by 460 bips. We are ahead of Stocks AI, which is the tracker of AI, by 250 bips as well. The IUM of the fund are $30 million US. We started only 6 weeks ago to sell the fund with 5 million seed money, and now we have 30 million in the course of 6 weeks. I think there are 3 things that make that fund unique. The first one is the fact that we use probably what is more modern for an asset manager, which is algorithm to find ideas and to capture the trend on company. 1, 2, a quant model that has a 10 years track record in an open portfolio at ODDO BHF called Minvar. And third, we have PMs reviewing the portfolio with 20 years experience on listed equity. So maybe a quick presentation of the team. So there are 2 portfolio managers. I'm lucky enough to work with a young engineer that is the PM portfolio manager on quantitative things. And I have myself that has 20 years experience in capital market. I spent most of my career in Paris and in London as a technology analyst. A quick introduction about artificial intelligence. I think most of you know already what it is, but it's just a reminder. So finally, artificial intelligence is the capacity of an algorithm, a high-performance computer, to think like a human being. Okay, so this has been the dream of the past 70 years of computer sciences. Why it is possible today? It is possible today because the raw material of artificial intelligence are the data. And today you know that we issued by our life, by our economies in the world, trillions of data. So we have talked about big data before AI. So this is the raw material. And there is a second thing that makes it possible. This is what I call the semiconductor industry. You need this semiconductor to collect the data. We talk about sensors. You need this semiconductor to process the data, to analyze companies like Intel, AMD, NVIDIA. So we do believe that semiconductors are the oil of the 21st century. We do believe we are going to have a super cycle of semiconductor. I will come back on that later. Why you should invest in artificial intelligence, or why not? First of all, because of growth. I think Gartner estimates that artificial intelligence is going to grow by 23% per annum over the next 7 years. So if you compound 23% during 7 years, it's a lot of money at the end of the game. Compare it with cyber security, that is a very interesting theme in itself, is just growing 7 to 9. Global tech is probably growing around 5%. So it makes a huge difference. But more than that, Gartner talks about the value that is going to be widespread in the economy through artificial intelligence, and we talk about trillions of US dollars. So you have a white paper with you that we have written on the topic. There are a lot of data on that, but we have talked about a silent revolution that is going to go through all the economy of all the sectors of the economy. Sorry. So I'm going to move quickly to this slide and going to probably what matters for you when considering the fund is the investment process. I said in my introduction that we are probably using in that fund what is more robust, innovative, and efficient for an asset manager. On step 1, we use big data and AI. We start from 3,500 companies, which is an MSCI World Extended, and our commitment at the end of this step 1 is to find for you the top 300 companies every quarter in the world, whatever countries, market cap, sectors, most exposed to artificial intelligence. By that, I mean the ones that are going to create more economic value, EPS growth, free cash flow growth from artificial intelligence. And we believe that economic value should be reflected in shareholder value. We don't do that by ourselves. For example, if you are named BlackRock, you hire people from Google, hundreds of them, data scientists to work with asset manager. We are ODDO BHF. We have just 100 billion under asset management, so we are a medium-sized player. But what we did 2 years before launching the fund is setting up an exclusive partnership with one of the biggest companies in Europe on big data and AI. That means that these people, for us, they screen 4 million data per day on Bloomberg. Their algorithms screen all the company, all the words, and we get a very interesting outcome. I will come back on that. We cannot name this company here, but just to describe them, they have 100 clients out of the Fortune 500. They work with Coca-Cola, Facebook to help them know their clients. So they are pure data scientists, and we talk with pure data scientists, and we have conscious exchange with them. So at the end of step 1, we have the top 300 companies. And then these top 300 companies come to step 2 with a total different logic. In step 1, we use unstructured data. And in step 2, we are going to use a purely quant model, valuation, momentum, quality. And here we use structured data, price, earnings, free cash flow growth, and so on. And out of this top 300, at the end of step 2, we are likely to get to the top 60, to the top 100. And step 3 is human control. We have decided to put a human sanity check all over the portfolio. We have decided that human PMs are going to screen the portfolio on a constant basis. And here we select the top 60 companies out of the selection of step 2, top 100. It was a choice. We could have had a fully AI-driven fund. We decided to put human intervention every year. So let me describe you a bit the step 1 that is the more innovative for you. What do we do there? We do 2 things. We do semantic analysis and we do sentiment analysis. So prior to launching the fund, we had a lot of exchange with the data scientists. What is artificial intelligence? We believe it is that in the white paper. They were data scientists, they have their own view. But more than that, they use their algorithm to capture what are the words, what are the subthemes related to AI. And by dint of quarter of exchanges, we have built that big library, 5 subthemes: big data, automatization, machine learning, deep learning, cognitive computing. For every of these big subthemes, you have 100 in total 170 keywords. So how does it work? Here you can see that on the horizontal axis, you have all the keywords. I'm sorry, it's a bit small. And in the vertical axis, you have all the company. So take the example of deep learning, number 4, and first keyword GPU. You will find GPU screening very well with the listed company, NVIDIA. That is the red square that is a bit surrounded here. It looks easy on NVIDIA and GPU and artificial intelligence, of course. But when you start to analyze 3,500 companies, believe me, you find ideas that you would never have found by yourself as a PM. You fight against a cognitive bias. I can work very hard. I will know 120 companies by heart. With my colleague, 250. The result with that, we are able to capture ideas in 3,500 companies. It's very powerful. But we don't do that, because at the same time, we do sentiment analysis. And here is the most important, because this is the alpha generation of the fund, at least part of it. Each time we find an article with NVIDIA and GPU, the powerful algorithm of our partner are able to understand the meaning of the text. Is it a positive article? NVIDIA is expanding, creating jobs, EPS up, or ethics problem, firing people, whatever. If it is positive, we put +1. If it is negative, we put -1. So that means that at the end of that process, you have all the companies listed, top 300, with score from algorithm, combining semantic, which is quant, number of occurrences, but combining the trend analysis. And believe me, when I see what is happening in the portfolio, the ideas that come, when I look at the top 10 performers of the portfolio, literally, most of them are companies below 7 billion in the world, 7 billion market cap, we didn't know before, and that are reporting numbers very good. Then there is capital market day, numbers are revised up. So the hit ratio of that process is very strong. And I think it should be related to what I said to the performance of the fund at the beginning. Of course, I can provide you many examples in the world of companies in the portfolio that have been very good surprise for us. Very quickly here, this is the step 2, the quant model. So very classical things, valuation, quality, momentum. And we have added a bonus size. We put a positive note for small companies. So once again, this quant model has been proven during years in Minvar portfolio at ODDO BHF, and it has a track record of outperformance to benchmarks that is quite impressive. Last steps, it is the human intervention when we have a long list of exclusion of stock selected by the machine. Most of them are automatic exclusion. Some of them are discretionary in exceptional cases. I precise that there are 60 stocks in a portfolio, quarterly rebalancing, but in between of this quarter, we can sell and buy companies because sometimes we receive alert from the algorithm. Like last week, we sold one US stock because we received an alert that the sentiment has gone down very much. So this is a very dynamic approach of managing the portfolio, I would say. So let's look a bit of what is... I think there is a problem. Can I have some help for flipping the slide, please? It does not work anymore. Muchas gracias. So, what is the portfolio today? As I told you, looking at the left-hand side, there is the sectors. You have 56% of global technology companies and 44% on non-tech companies. So spending the past 20 years in the research of technology companies, this is my commitment to you today, that you will find the best tech companies in semiconductor, in software, in storage, in IT services. I want to tell you something. When we launched the portfolio 19th of December, thanks to that big process, algorithm, quant model, and our view, we decided to have 25% semiconductor. You probably remember that end of last year, nobody wanted to own semiconductor. The stock I divided by 2. We own semiconductor because it is very relevant to artificial intelligence, but we own semiconductor so much overweight because also we believe there is alpha. We believe that it is the oil of the 20th century. We believe that all the stars are aligned for semiconductor. Car industry, tripling of content of semiconductor. Data center, do you imagine Amazon, Facebook, Google, the number of servers inside the farm, in each server the number of semiconductor? Mobile phone, going down the unit, but content increasing. Artificial intelligence, the chip of artificial intelligence, you are going to have chips with 21 billion transistors. Qualcomm yesterday said they are going to think about new chip of AI. 5G. On the roof of this building, you are going to have $100 chips for 5G. It is a quantum leap. We are invested in all these companies. So I see there are a lot of technical problems today, probably not artificial intelligence here. Anyway, I will continue on that without the slide. So on the portfolio, 56% global tech and 44% non-tech. Maybe what is interesting is the 44% non-global tech. We are able to capture companies with very strong equity story. For example, from day one, we bought a US company called WAPCO. Nobody would think about this company. They are manufacturing suspension and brakes for trucks and buses. I didn't know the company before. The algorithm identified very well with semantic analysis what's going. And guess what? This company has been acquired 10 days ago by a German ZF with a premium of 30%, and we sold since them. Why? Because of their technology advantage on AI, they have become a key asset for autonomous driving. So all the competitors wanted to buy WAPCO. This is one example. We own the Israeli company Mellanox that has been acquired by NVIDIA. Second example. Or more recent boat, for example, we bought a company called Target. Everybody knows Target, the big US retailer, not a sexy business. They are closing stores and so on. But you see the share price of Target like that. So you see something is happening in the company. What's going on? But you realize, yes, they are closing stores, but they are reopening store and rejuvenate the store. But more than that, they are using artificial intelligence to have a lean supply chain where they can basically fill their delivery trucks before knowing the demand of client. Something is happening in that company. We are just buying the company 6 weeks ago, but the trend is pretty interesting. Another example, when we launched the fund, we bought just one Chinese company, Lenovo. Not really a sexy business, Lenovo PC, declining units and so on. But it happens that Lenovo is a very well-run company. It happens that Lenovo, since we bought, is probably up between 25 and 30%. When they report, the stock was up very much. After that, Capital Market Day, analysts revise up the earnings and so on. So you see the combination of algorithm when you capture a trend early, plus a quant model that tell you when to buy, what about the momentum and so on, plus a modest human sanity check at the end, but we have to be humble because the machine is very strong, that give you very interesting results. And just to come back, I am lucky enough to have the image again. So you see also that the fund is pretty much US, 60% US, 10% Japan. We have very good stories in Japan because of robotic sectors, because of semi-sectors. We are able to capture the growth in emerging. We bought the Russian Google, Yandex. This is an absolutely fascinating company in Russia. Spotify in Russia, Amazon Echo in Russia, Uber in Russia, Google in Russia. This is Yandex. The company is up more than 25% since we bought. And Europe, of course, where it is difficult to find ideas. I admit that. And today we just have 30% small and medium caps. This is again when the performance is coming from. When we launched the fund, we had up to 50% small and medium cap. So I want to conclude on that. There are three things that make the fund unique and maybe differentiating for you. Is one, we use the most modern tools at the disposal of an asset manager, algorithm, quant model, and senior analyst checking everything. Second, we have 30 to 50% small and mid-cap companies in the fund. That means that we are underweight the GAFA. We own Google, we own Amazon, we own Facebook, but much less. It will never be more than 10 to 15% of the portfolio. And the third thing I think is important, it's not a purely global tech fund. Only half is technology, a big half, and the rest is diversified in all the sectors, but with strong competitive advantage companies driven by AI. Thank you. I'm open for questions.